Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 353 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about the recent quote-unquote correction we had in the stock market, how we are roaring back, and then some lessons that we can learn from losers in the stock market, the lessons that we can learn from bull markets coming and bull markets going and bull markets slowing down, and all of these things. I just want to talk about the market, the sentiment that is going around in the market, and then ways in which we should be treating the market based on historical evidence. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, look, I don't know how much you keep up with the stock market. I don't know how much you keep up with the S&P 500. I just don't know, right? But my idea is, hey, if you're watching this show, you at least care a little bit and would like to learn more. If not, you already keep up with it quite a bit. Now, if you have kept up with it in any way, shape, or form, you know that we hit a 52-week high on the S&P 500 of 47.43.83, and that happened towards the end of November, right? And we took quite the precipitous drop from there. The market went down nearly 5% over that time period, right? It really had a rough go of things, but 5%. What is 5%, right? 5% is not even considered a correction in many cases, right? 5% is nothing over the long term when it comes to the stock market, right? And it's important for us to realize that this isn't that big a deal. It's not such a big deal over the long term in the stock market. Yes, we have bounced back from it, and I'll talk about that here shortly and talk about if it's actually over, if this correction or little blip on the radar of the market is actually over. But maybe we need to be reminded of what history actually looks like. I think we've gotten so used to gains. I think we've gotten so used to the past couple of years, especially a lot of new retail investors jumping into the market and getting real interested in all the flashing lights of the market, all of the glamorous things. And they forget that the market has quite the history of going down just as much as it has a history of going up over long periods of time, right? So let's just say that we looked at the S&P 500 and we said since the 2008 crash, right? So since the financial crisis, how many drawdowns have we seen? Or what are the worst drawdowns that we have seen, right? And you might be pretty surprised at how pronounced these drawdowns have been. And you might also be pretty surprised at when they occurred, right? So the first one in 2010, from late April to early July, there was a drawdown of 16% in the stock market. I'm just saying, if we had a 16% drawdown for any reason, I think nowadays people would, be all over it. They would be buying the dip. They would be, freaking out, of course, as it dropped. But I think people would buy the dip. And I think that's a big thing that's going on in our markets is that, the market may want to correct. It may want to go down. But there is so much money in the system that, people are just buying the dip. Institutions are just buying the dips, right? And as long as they keep buying the dips, then the drawdowns cannot continue, right? They cannot continue further and further down. So there was a 16% drop. In late April 2011, all the way to early October of 2011, there was a 19.4% drawdown, so almost a whole bear market out of that time period. And that's no short time period, right? We're talking there, 5 months, right? 5 months over which the market trickled down to where it was 19.4% down. That's quite substantial. Okay, then from early November 2015 to mid-February of 2016, the market drew down 13.3%. In 2018, the market fell more than 10% twice, right? More than 10% twice. Okay, so in January of 2018, late January, all the way to just the second week of February. So this happened very quick. The market fell 10.2%. Then late September to late December of 2018, the market fell 19.8%. Okay, then you had, obviously in 2020, a 33.9% drawdown from the highs from February 19th to March 23rd. So we have seen a bunch of drawdowns, especially in the S&P 500. So then you go to the S&P 500 and you say, okay, then since 2008, right, what have our returns been? Okay, so you're just interested. You see all these drawdowns. Well, is that tearing up our returns? Is that destroying our returns? So what I'm going to do is I'm just going to start in 2009, right? So we're saying after 2008, and the market bottomed in 2009, early 2009 anyway, right? And we just take that to the end of November of this year, right? The annualized S&P 500 return, okay, without reinvesting dividends, over that time, is 12.963% per year. And the annualized S&P 500 return with dividends reinvested is 15.109% per year. Okay, so we've had some outstanding gains since then, even with those pretty substantial drops in the value of the stock market. So what's that tell you? Those corrections occur and things just keep on going. And I think it's notable when you look at those corrections, those 10% or more drops, 10% or more drawdowns. How many of those did you actually remember occurring? Right? How many of those did you actually know happen? Now, the one in early 2018 stood out to me specifically because I was an investment advisor representative at the time. People were freaking out. The market fell 10% quite quickly, right? But that was the least of these 6 drawdowns that we were talking about, right? But how many of these do you remember? How many of these actually had an impact on your investing over the long term? Truly, we look at the returns. None of them really did. Okay, even the coronavirus crash. Now, obviously, that's the one we're all going to remember, right? But even that one, when it comes to our investment returns, can be easily forgotten. Okay, now that's since 2009. Let's just say I backed it up to 2008, so the market hadn't completely crashed yet. So you say November of 2008 to November of 2021. What are we looking at? We're actually looking at better returns over that time period than we would be if we were looking from November of 2009. I actually did from November to November. Okay, but nonetheless, fantastic returns even in the face of times when the bull markets have been struggling. Now, the Russell 2000, right, which the Russell 2000 index, it encompasses more companies than the S&P 500, right? The S&P 500 is 500 large cap companies. The Russell 2000 takes into account some mid and small cap companies as well. And if we looked at some of its drawdowns, then you'd be like, man, right? There was a drawdown in 2010 of 20.5%, 2011, 29.5%, 2015 to 2016 of 26.4%, in 2018, 27.2%. And in 2020, the coronavirus crash, 41.6%, the Russell 2000 was down, right? This is not insignificant. Now, this would be if you had some smaller mid-cap exposure in that way, you would have seen very significant drops as well, right? So it makes you wonder, okay, well, has the Russell 2000, has it struggled with its returns? Maybe it's struggled given that those types of major corrections and bear markets have occurred. Well, let's find out. So if you just look at a chart of the S&P 500 and the Russell 2000 overlaid with one another, we've established that the Russell 2000 has had greater drawdowns, right? What have the returns been? And we're looking here since 2004. Okay, since 2004. So this is before all of these drops, but this takes into account the financial crisis and everything else, right? So since 2004, the S&P 500 is up 326.58%. Okay, The Russell 2000, not up as much as the S&P 500 because large caps have won as of recent years, but is up 310.86%. So still absolutely no slouch. I would gladly invest in that group of companies, right? So ultimately, we see these drawdowns, these corrections, they don't really hurt over the long term, right? So when we see these little 5% blips, I think it's very important to remember that the market's going to work itself out. It's going to play through. It's going to run its course in one way or another, but it's not always easy. Right? It's not always easy to see what the market does because one of these days, and whether it's sooner or later, who knows, right? We'll see another 10+% correction, right? We'll see another 20+% bear market. We'll see 30, 40% down. And then the question becomes, what are you going to do, right? Because bull markets are not easy. Now, bull markets are long and bull markets are fun when they're going really well, but they aren't always easy because you can have these drawdowns even in the midst of some of the greatest stock returns that we've ever had over a sustainable period. Okay. Now, when it comes to those periods, I think it's interesting to note that in many instances, right, picking losers in the stock market is quite easy, but picking winners in the stock market is quite difficult, right? If you wonder why I tell you to buy indexes or buy mutual funds or diversify or whatever, is because buying losers is quite easy, right? Buying winners can be quite hard. Okay, so let's just say that we just backed up a bit, right, and just looked at the top constituents of the S&P 500 over time. Okay, and we're not even looking at the most recent, but let's just say you backed up to 1980, let's say, and I asked you what were the top companies in the S&P 500, the top 10 companies, right? I don't think you could tell me. Right, I think you would miss on a lot of these. Now, are a lot of these well-known companies still? Sure. But none of them, I don't think, not one. Maybe, let's see, in 2015, there was just, two of them left, right? Two of the companies that were the most valuable in 1980 were the most valuable in 2015 in the S&P 500, but I don't think any of those remain in the top 10. So, in 1980, IBM, AT&T, Exxon, Standard Oil Indiana, Schlumberger, Shell Oil, Mobil Corp, Standard Oil of California, Atlantic Richfield, and General Electric, right? Those were the top 5 constituents of the S&P 500, okay? And they made up 25.54% of the S&P 500. But you go to 2015, right? You had Apple, Google, Microsoft, Berkshire Hathaway, none of which were on that 1980 list. ExxonMobil was on the list, but let's see. At this point, their allocation in the index had been cut in half. Okay. Then there was Amazon, wasn't on the list in 1980. General Electric, which they'd actually picked up a little bit of their constituency in the S&P 500 by this point. Then Facebook, which wasn't on the list. Johnson & Johnson wasn't on the list, and Wells Fargo, which also was not on the list. Right? So what's this tell you is that markets change a lot over a long period of time, and that there can be some really great winners, Apple's, Google's, Microsoft's, all these types of things, right? But what if you were just investing in some of the largest companies back then, right? What would have happened if you would have invested in IBM stock almost exclusively, right? What if you went back to 1980, which I'm going to do for you, right? And I'm actually going to go to 1981, right? If you went from 1981, December 11th of 1981 to today, right? And IBM stock, you would have made 836.67%, which sounds like a lot, and I'll admit is a better return than I anticipated out of that stock. But let's compare that, right? Let's compare that to another company, and let's compare it to a company that, today is the most valuable company in the world, and that is Apple, right? So we go to the complete chart for both of them, right? And we take this all the way back. This is December 18th of 1981, right? And what do we get? Well, Apple ended up making over 171,000% since then, okay? And let's see, IBM was 797.27% over that time period, right? So even if you would have bought the best company, you would have made some returns, but nowhere near the returns of the companies that actually overtake them, right? So picking a winner, picking the biggest winners is very, very, very difficult. But truly, you don't have to pick the biggest winners, and you don't have to stick with them for 40 years or whatever. You can still make good money over time. But the truth and the thing that you have to understand based on these S&P 500 constituencies is, again, right? Bear markets can knock some companies off, and bull markets can create a lot of innovation, a lot of new companies that come into the market and become the most valuable companies in the world, right? So it's important to note. Now, something that you may find interesting is that if you looked and you just said, what percentage of companies experienced a catastrophic loss, right? And when we're saying catastrophic loss here, right? What we're saying is the stock fell 70% from peak levels and never reached those levels again. Okay, so a huge drop and never reached those levels again. Okay, if you looked since 1980, right, 44% of all stocks, 44% had a catastrophic loss. So 44% fell at least 70% and never reached their top levels again, which is crazy, right? Then you look by sector, 65% of energy stocks since 1980 did that. 59% of information technology stocks, right? 49% of communication services, 48% of consumer discretionaries, right? Stocks, they take big losses, right? Especially individual stocks. They take absolutely huge losses sometimes, right? And this is okay, right? This isn't, the worst thing ever, but ultimately it reminds us that picking stocks is hard, right? And picking the right stocks and sticking with the right stocks over a long period of time is very, very hard. So even though we can look back at those bull market returns and we can say, man, the returns of the market have been great, right? Well, some people haven't gotten those returns because they've stuck with some companies that just don't make the returns that they thought they would, right? Or have some catastrophic losses because they become basically irrelevant relative to what they used to be, right? Just think about that leaderboard from back in 1980. It was a lot of oil companies, right? And they don't even break the top 10 nowadays. Right, and you basically see, IBM, that's a tech company, but really very little tech in the way that we think of it. But now tech dominates the S&P 500. So markets change, right, and sectors change, and companies change, but ultimately a lot of companies fall off. So picking individual stocks is hard. This is why being diversified, why having index funds and just pouring into those index funds on a consistent basis is very useful. But you can put money into individual stocks. You just have to be thoughtful about this process and not just stick with something because it's the largest company in the world. Because like I said, bull markets aren't always easy, and they're even less easy. They're even more difficult when you have a big drawdown or you have a big correction or something, and you have to take some huge losses because you're invested in some stocks that are pretty well beat up. Now, that kind of brings me to my next point, is that there are a lot of stocks that are pretty well beat up right now that have taken what some see now. Obviously, they haven't been deemed catastrophic just yet, but they've taken some absolutely huge losses, right? So let's just look at some of the few that we can say peak to trough. They've really had a hard time, right? So peak to trough, what's up with PayPal, right? Down 41.88% since July, right? That is a big loser, right? Let's look at Zoom, right? Zoom video, right? Zoom communications, right? If you go peak to trough again, right? You go peak in February, and they've basically still been going down over, let's see, 58%, 59% peak to trough, right? That's a big loss, okay? Let's see what else. The Peloton thing, right? The Peloton thing's been absolutely crazy, right? Peloton was a killer during the pandemic, but now we've seen some pretty substantiated losses in Peloton. So Peloton's high, let's see when that high came. It's hard to even put a figure on when they actually met that high. Maybe in mid-January, right? And from there to today, they're down 75%. Now, are these the worst companies ever? I don't know. I don't think so, right? But do these companies have something to prove based on the fact that they were obviously way overvalued at the peak of retail investing and things like that. Maybe so. Now, something that's interesting and something that we may keep in mind is that if you have companies like this that you've heard of, right, that are well-known companies that are down 40, 50, 60, 75+%, right, and the market only went down 5%, what's that tell you? That tells you that the leadership in the market has been extremely strong, right? We've seen some extremely strong leadership. And again, if you're invested in Peloton or you've been invested in Zoom or whatever, you've taken a bloodbath. But if you've been invested in a diversified group of companies, if you've been invested in the S&P 500, right? You just go back 1 year, S&P 500, 26.59%. You can't beat that. Right? Now you could beat it. Obviously, there are companies that have beat it, but on a sustainable basis, it's just so hard to beat the S&P 500, even with some of the most innovative companies that we see. Now, the real question is the correction over? Right? Have we gone down? Let's see. The peak to trough decline we saw was just 5.2%, right, on the S&P 500. And it kind of feels ridiculous because at the same time that we've seen that occur, right, we've seen 5.2% down. The S&P 500, like I said, is still up 26+% at this point. Now it was up just a little over 21 at the trough, but now we're up to 26 plus again, right? So it's very strange. It's very weird that we feel like something has gone awry or something's wrong when the market is just fine. And the market has done way more than you could ever ask the market to do in a given year. But we're spoiled by these returns. And so there was this chart that I saw recently from Michael Batnick, who does, what are your thoughts? And, he's on the Compound channel, and he's on Animal Spirits with Ben Carlson. And he was showing that if you take the number of NASDAQ stocks that made new 52-week lows, right? So just the number of the stocks in the NASDAQ that made new 52-week lows, right? Lowest they've been in a year. And then you overlaid the NASDAQ composite index there. Every time you saw a major spike in the new 52-week lows, that was calling the bottom of the NASDAQ, right? And we have seen quite the precipitous drop in the NASDAQ recently, right? So if we just want to look at it real quick, the NASDAQ from peak to trough recently, we have gone, let's see, I don't think that's quite indicative. It was closer to 10%. I know a lot of small cap mutual funds and ETFs fell 10% or 10% or more recently. And over 1 year, the NASDAQ's up 24.67%, so lagging the S&P a bit, but still up in a very, very big way, right? So we see that, okay, every time that this number spikes, this new 52-week low spikes, then we can see a bottom in the NASDAQ. And you look over the history of this particular graph, and every time that it happened, it was true. The chart reversed, right? And the NASDAQ continued upward. So is this correction over? Truly? Who knows? Maybe, right? I surely can't tell you. I can't tell you if we are, turning around here or not. What I can tell you is that we've taken a bit of a beating in the short term. But like I said, when we were talking about bull markets not being easy, bull markets aren't easy, right? So watching the stock market go up day after day after day is not what's necessarily going to happen. Okay, and not only is that not going to happen, there can be some extended periods where the stock market goes down, right? We look at some of these periods of time on these S&P 500 drawdowns I was talking about. The one in 2011 was from April to October, right? Could you imagine there being a continuous downward trend in the market for, like I said earlier, 5 months? I mean, that's an outrageous thought to us now, but it's something that the market does. Right? And we have to be very well versed in market history so we can understand what we should expect from the market moving forward. No, the market is not going to always provide you 25+% returns like it has been doing. It's not going to even provide you, very likely, the 15+% returns that you've seen since the bottom of the financial crisis. It's just not going to happen. Okay? If it does happen, I will be shocked. Okay? But it's not very likely to occur. And over a longer period of time, it has not occurred, right? So we have to be prepared for the fact that the market does not owe you anything. Okay, the market has some major drawdowns. The market has some major weaknesses from time to time. And guess what you do? You keep buying, you keep buying, you keep your investment strategy, you keep working through it. And ultimately, you don't quit, right? You don't jump out. You don't jump out just because the market fell 10%. You don't jump out if the market falls 5%. That's ridiculous, right? 5% is almost the perfect level at which you could just buy a little more, buy a little more, buy a little more, right? Look. All I'm trying to get through to you in today's episode, I know I've hit on a couple different things. What I'm really trying to get through to you is that investing is a marathon. It's not a sprint. Okay, so we've seen a lot of things in our recent sprint that could make us go, dang, that's tough. Or woohoo, the market's back up and everything's rocking, or the market's been rocking, or whatever. Maybe you've owned stocks like Peloton or Zoom or PayPal or whatever, and you've just taken a bloodbath in those things and you feel like the market is horrendous and rigged and this doesn't make sense and all these types of things. But you have to remember the market doesn't owe you anything, right? The market only owes you, right, basically the earnings of the companies that are within the market, right? And any money that they give back to shareholders, whether it's stock buybacks or dividends. Everything else, speculative. They don't owe you, right? So ultimately, we have to be prepared for that. We have to understand that and understand that what John Bogle says in his book, the little book on common sense investing, is true, right? That any return above that earnings yield and any return above the earnings yield plus the amount that is returned to shareholders is all speculative return, right? And the higher that speculative return gets, then the lower that future returns will be. So maybe we should be prepared for lower future returns. But nonetheless, low future returns, high future returns, whatever, what am I going to be doing? I am going to be investing. And I'm going to be investing, and I'm going to be doing it every time that I get a paycheck, every time my wife gets a paycheck, we are going to invest, right? Because it is the best historical way to build wealth, right? It is the most reliable historical way to build wealth in the United States. And it can help the smallest of the small build wealth to become part of that 1% when it comes to being a millionaire or a multimillionaire or whatever else, right? And that's what I want for you guys. I want you guys to build wealth, and I want you to have money that you can have options with. I want you to have financial freedom. Ultimately, that is my goal for every single one of you. And you cannot have financial freedom when your goal is to, okay, I'm going to invest in the stock market, and you have a 2-year time horizon or a 3-year time horizon, or if the market drops 10%, you freak out, or 20%, you freak out, or you think that the market's broken. You have to understand what the market has done. Look, I know that I give you a lot of this information, but go and look it up for yourself, right? Don't just believe me. Go and look it up for yourself. Go and look up, how many times the stock market's dropped 10%. Go and look up over the past 100 years how many bear markets, 20% or more drops in the S&P 500 have there been. Go look up how many stocks crash every year, right? How many stocks drop by more than 50%, and you will be absolutely stunned. And you'll understand why I take this stance on investing and why I say that investing in index funds and mutual funds is vital, right, to long-term wealth building. And picking individual stocks should not be done by everyone, and it should absolutely be done with caution and be done with a true long-term viewpoint for the stocks that you hold, right? So hopefully this is helpful to you. Hopefully this gives you a little context for how I think about the market, and hopefully it can teach you in a way that will allow you to think about the market in a healthy way and be able to grow forward in your knowledge of all things investing and be able to actually act and actually invest with a cool head and doing so over the long term. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.